Hi guys, welcome to day one. So today we'll be talking about how do we identify trends in the market that will make us a lot of money. So before we actually get started, I just want to show you a quick screenshot of my Tradzilla from Interactive Brokers that I've made over slightly about $140,000 in July, 1st of July to 31st. And from the 1st of June to 30th of September, I've made over $300,000 in real money. So I just want to show you that simple strategy actually works. So we want to keep things as simple as possible. That's our goal, right? So with that being said, let's talk about candlestick. We want to talk about the basic understanding of candlestick because this video is for those who are about to get started. So if you are already a veteran in trading, you can probably skip to the later part of the video. So let's just go through really quick. So there's two types of candlestick. The green candlestick means it's bullish, and the red candlestick means that it's bearish. So what we're trying to tell you, what this candlestick actually tells you is that the price essentially opens at this price range. In this case, let's say it's $1, and then it closes higher than $1, which is $1.30. It closes here. That's the body. That's what the body is telling us. What the wick essentially is telling us is that the price actually been to this high at $1.50, but it's unable to close at that price. It came down to 130 and it closes right here. And the same thing for the lower part of the wick is that the price opens up at $1, then it went to 80 cents, which if the price went below the open, it will actually form a red candle, but it didn't actually close here. The buyers push the price back up and it closes at 130. So that's what it's telling you. So we can say that the price closed higher than the open. That's why there's a bullish candle. And same thing for the red candle. We call this a bearish candle. The price actually opens up at $5 in this case, and then the price close below $5, which is at $3 right here. So then it forms a bearish candle. So what we're trying to do here, right, is very, very simple. So our goal is actually to buy somewhere. Let's say this is just a very generalized scenario. So let's say we buy our price right at around this level. Let's say we buy our price around this level. Then our goal is to sell it at a higher price. Then we can earn whatever is in between. And for selling, it's the same thing. Let's say we want to sell our stock right here, and then we want to close our position right here. So we want to sell at high price, and then we close at low price. Then you will essentially make money. So it's very simple. If you guys want to know more about candlestick, you can just go on YouTube, and there's a bunch of videos from other people as well. I don't want to go too deep in here, so I just want to explain to you the basic things about candlestick and what it means. All right. With that being said, today we're going to talk about how do we identify trends in the market. So there are only three types of waves that the market can move. So in an uptrend, or it can go sideways, or in a downtrend. So how can we identify these sort of patterns? It's fairly simple, actually. So for an uptrend, we always want to see a higher highs being built. What do we mean by higher high? So stocks always move in waves, all right? They don't move in a straight line. The stock doesn't go all the way like this or like this. It doesn't go that way. What it does is it moves in waves. So what we want to identify is that we want to find a low and a high. Then we want to identify there's a higher low. What this, I'm sorry, higher low. I think I have a typo. So let's just put this higher low. Higher low. What higher low essentially means is that this low is actually higher than this low. And this low is higher than this low. As you can see, this low is higher than this low, and it's higher than this low. So there's always a higher low and a higher high. So once we have this sort of pattern, we know it's an uptrend because there's a low, there's a higher low, higher high, higher high, higher low. So we know that this is a very clear uptrend. For this kind of scenario, we want to only enter buys, or we call it longs. These two are the same meaning, buy and longs. So we want to enter buys and longs only in an uptrend like this. So for a downtrend, essentially what it means is the opposite of an uptrend, which is there's a high, there's a low, there's a higher, there's a, damn, I need to like sort these things out, man. This is a low, lower high, lower low. This is a lower low. So what it means is that essentially there's a high, there is a low, there's a lower high, there's a lower low. So we want to identify trends that are going down. These are very obvious because this low is lower than this one, and this high is lower than this high. So it's very obvious that there is a low, there's a high, there's a low, there's a lower high, and there's a lower low. So in a downtrend, we want to identify, um, you know, identify these lower high and lower lows. Then we will look for shorts. It's very straightforward. For the third scenario is what we call the consolidations. So if there's an equal high and equal lows, what essentially we will do is that we won't do anything. We will not enter a long, nor will we enter any shorts, because these kind of patterns doesn't give us a lot of momentum. So we want to know how to identify these three patterns: an uptrend, consolidation, or you can call it sideways, and downtrend. So these three things are very basic, and before we actually go into real life example, we actually need to understand how do we identify it. So now we know what is an uptrend, which is a higher high, higher low. Downtrend, a lower high, lower low. And sideways, it means equal high or equal lows. Reactions is what we're trying to say. So there is an easier way. I mean, visually, right, we can actually see whether a stock is an uptrend, downtrend, or sideways. But there are an easier method I always use to identify as well. So let's just give you it. So the easier method is that I want you to go to trading view. So I want you to open the indicator section. I want you to type in EMA, exponential moving average. And once you have that, it's very simple. So you just click into the settings and you change the EMA time frame to 1 day. So what do I mean? I'm just going to go through really quickly. So let's say I'm just going to cancel this. I get into my trading view. I go to the indicator section. I'll type in EMA. So moving average exponential. I'll click on it. So it pop out right here, EMA 9. So what we're going to do is that we click into settings. We go to the length and change it to 20 because we want EMA 20. And we will change the time frame to day. Press OK. So now it becomes 1 day EMA 20. So this blue line is the EMA 20. So what the EMA 20 actually tells us is that if the price is above the EMA 20 for 3 days, it means we are long bias. And if the stock is below the EMA for 3 days, we are short bias. So it's very simple. And remember when we talk about the higher high and higher low uptrend, and for the lower high and lower low for the downtrend. So we want to combine these two methods to identify whether we are long bias or short bias. All right, let's go into an example. So remember we talked about 3 days, right? So let's say this Starbucks right here, the 1 hour time frame. So when do we know that we are long bias or short bias? Is that once the price went above here, let's just change the color. The price went above the EMA 20. The red line is the EMA 20. Then we need to wait for 3 days. So this is the 16 of January. So 3 days will give us around 19. So around this time frame, which is a 19, it's been above the price has been above the EMA 20 for more than 3 days. So we're actually long bias starting from here because it went above the EMA 20 and it's been up for 3 days. So this is a long bias. So we want to long the stock from this point onwards. We are long bias for this stock. So we want to find an entry for long. So today we are just identifying the trend. We are not talking about how do we enter a stock. The entry video will be later part of the courses. So as you can see, there's very clear. There's a higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. As you can see, there's a very clear uptrend in this case. So that's what we're trying to identify. So we can identify this stock as a long bias. All right. Okay. It's very very simple. So the next example, we're going to use Lyft. So when can we be long bias on this stock? It's very simple as well. As you can see, this is the EMA 20, the red color line. So the stock went above the EMA 20 on roughly the 14th, right? The 14th of February. The 14th of February. So from this 14th of February to the 17th of February, which is around this time frame here, from this point onwards, we're actually long bias than anything else. And it's very obvious. So as you can see, the structure is very beautiful as well. So there's a higher high, higher low, higher high, higher low, higher high, higher low. So it's a very obvious uptrend. So in this case, we know that it's a long bias. At this point of time, right? At this point of time, you wouldn't know what is happening behind here. At this part, you wouldn't know what is happening here. But what we know is that from this point onwards, we're actually long bias. So we are trying to look for a long entry. We're trying to look for buys instead of sells. That's what I'm trying to say. So you wouldn't know what is happening here yet. But if you were to enter a long at whichever point, either here or here, you would have made money because the stock went up anyways. It went all the way up. So identifying trend is very, very important because even if you don't have a precise entry, you will still have made money. All right. So same thing, we're going to go really quickly now. So very clear, the stock went above the EMA 20 at the 15, which is around this area. So from the 18, from this point onwards, we know that we are long bias. Why? Because it's above the EMA 20, the red line. And from this point onwards, we're only looking for longs. From this point onwards, you wouldn't know what is happening here. But if you were to enter a stock here, you have made money. If you enter at this point, which is a super high point, you would have made money at after some time. But we wouldn't enter randomly. But what I'm trying to say is that if you enter with the major trend following you following the major trend, you would have made money. Even if you have a very very bad entry. All right, so we know that this is a uptrend bias. We identify that this is an uptrend. Now let's go to the sideways example. So examples like this will tell you that there is not much bias. This is Salesforce, so CRM. So as you can see, the highs, the lows, and the lows are almost equal, and the highs are almost equal as well, right? So remember when you say that if they have equal highs and equal lows, it means that the price action is really choppy, and we wouldn't want to have any action. So in this case, it's very simple and straight and easy. There is no bias. We don't want to enter anything here. No shorts or no longs as well. So another example, still the same Salesforce. The red line is the EMA 20. It's not above the EMA 20 nor below. The price action has been choppy for the many past days or so. So for this case, it's a no entry as well, right? So for this one, it's clear. This is Snowflake. Snowflake, it has a very pricey, not pricey, choppy price action as well. So the price action has been going sideways because equal high, equal lows, pretty much everything is equal. So for this kind of range, we call this a range. We wouldn't want to enter buys or sells, so no action on this. So I think it's very straightforward. All right. So for downtrend, you can see immediately that it's very, very clear. Yeah. So the price went below the EMA 20 at this point, which is around the 5th of December. So from the 8th of December, around this area, we know from this point onwards, we are short bias, means we want to sell. So because it's been below the EMA 20 for the past many days. And it's very simple, right? I think it's pretty much self-explanatory. So if you go to the next example, Open, this is another stock, Open. So Open has been below the EMA 20 for many days. So whichever point you see, if you follow the trend, right, whichever point you enter a short, essentially you would have made money. It just depends on how efficient you are. So for this stock, it's very obvious. Everything it has been below the EMA 20 for many days, even from the beginning of this chart. So it's a short bias, means we only look for sells in this case, right? Okay, so this is Salesforce again. As you can see, Salesforce. So the red line is again EMA 20. So the EMA 20, the stock went above EMA 20. It came down right here, right? So this is like the 5th of February. So from the 8th of February, around this point, we already know that we are short buyers because it's been below the EMA 20 for 3 days. So we are only trying to look for sells in this case. And it's very obvious there's a lower low, lower high, lower low, lower high, lower low, lower high, lower low. So the structure itself, you can see that it's a very bearish structure. So in this kind of scenario, we only want to look for shorts. So it's very, what I'm trying to say, identifying the trend is very, very simple. And you need to always remember that the trend is your friend. So you always follow a trend and you'll make money. That's a very simple ideology. In the next few videos, I'll show you in these types of scenarios, in these types of downtrends, how do you find entries. So I'll see you in the next one. I'm trying to break the videos down into shorter duration so everyone can follow it at their own pace and try to absorb